Hello, good evening, everyone. Welcome to Ab India Karega Invest, our initiative to reach out to all of you on a weekly basis with a very interesting topic. Today's topic is a trending topic. I think a lot of investors and individuals are really looking at these category of funds. Basically, we call them as passive funds. So today's topic is active versus passive funds. To discuss on this, we have Mr. Pratik Oswal, who is the head of passive funds of Motilal Oswal Mutual Fund. So he's here to discuss more on this topic. I am Karthik. I am from a company called as Knowwise Learning Academy. We are into financial trainings. So I will start the session. Just give a brief introduction to active versus passive as a concept, set the foundation, and then hand over the floor to Pratik. And then subsequently, we'll open the floor to questions. Please feel free to post the questions. We would love to answer as many as them. Okay. So before we really jump into active versus passive as a funds, let's just probably understand first what is active fund and what is passive fund. So when we say an active fund management, the fund management team, that is the fund manager and that team, they really their objective is to beat the underlying benchmark. Okay. So suppose if it's a large cap fund, they would love to beat the underlying benchmark, that is Nifty 50 or BSE 100, whatever is the benchmark. How do they do that? Is by giving higher allocation or changing the allocation amongst sectors or stocks. So basically, there is a dynamic way of managing the portfolio. What is the sector which is expected to do well, give the overweight and so on. Okay, so the whole idea is to generate that extra return. We call it as alpha. Okay, so some of the examples of active fund management would be, this is one example where either you go overweight or underweight on certain sectors compared to the underlying benchmark. Okay, this is one example. Or you could go overweight or underweight on stocks. There are certain stocks which has, say, in the index has only 1% weightage, but you are going, say, 2.5% or 3% weightage into that particular stock. So one is sectoral play, the second is stocks, and third and a very important one would be on the allocation towards large, mid, and small cap categories itself. So there would be these three different ways where the fund manager would love to take that call based on the view of the market and everything, and then take it. Okay. The advantage here is if they get the call right, okay, then they would be beating the underlying benchmark and they will be able to generate that extra return to you as investors. Okay, but at the same time, for all this effort, what they would be taking, the expense ratio charged by these funds would be slightly higher compared to passive funds. It could be in the range of 1% to 2.25%. 2.25% being the highest, and then it starts coming down as the size of the mutual fund scheme starts growing bigger. A bigger the scheme, expense ratio would be lower. That's why it is in the range of 1 to 2.25%. So this is active fund. But then what is passive fund? As a passive fund, as a fund or as a fund manager, the idea is just to replicate the index. If there are 50 stocks in Nifty, I would have same 50 stocks in my portfolio in the same weightage, and even the sectoral weightage, would everything be same. I'm just replicating the index. Okay. What is the advantage? The biggest advantage here is certain calls what you have taken not necessarily have to go right all the time in active strategy, but here no such calls would be there. So you would be in line with the market. For example, when you look at the current, let's say last couple of months, when metal stocks did really well, some of the active funds really missed out on going big on metal as a sector. Okay, so that's where the passive funds end up scoring, because there is always that element of the decisions what you've taken going right or wrong. So if I were to put active funds and passive funds in a very, very simple way, you go to a nice restaurant in a different city. You're not in your current city. You've gone to a new city. You've gone to a new restaurant, and then the waiter gives you the menu. So you have to look at the food, and then you have to pick and choose. That's the order what you're taking. That is your active strategy. The passive strategy would be like you'd go for the buffet. Okay, it's already set. You taste everything, and then there's some bit of everything in your on your plate. Then at least you will not go wrong with the overall taste of the food. But in a la carte, the challenge there is, whatever food you ordered, that particular one dish, you might or might not like it. Okay, that could be the simplified way of explaining active and passive funds. So how is that as an investor? How can we invest in the passive strategy? Okay. So one way is directly go buy all the 50 stocks of Nifty or all 30 stocks of Sensex or whatever index you're trying to replicate. But for that, you need large amount of money. The simplified way could be, one method is invest in index funds, where you would be directly dealing with the mutual fund company, buy and sell the units, and then that particular scheme is replicating the index. Their portfolio would consist of same stocks. So all the strategies, whatever we discussed for passive fund, would remain same for index fund. The only key differentiating factor here is you would be dealing with the AMC directly. The other method would be is via investing through exchange traded funds. As a concept itself is relatively new to India. Probably early 2000s is when we saw emergence of ETFs in India, but subsequently it caught up the really momentum in the last 5 years or so. But exchange traded funds, as the name suggests, these mutual fund scheme units are listed and traded in stock exchange. So you can call them as combination of stocks and mutual funds. The advantage is you can buy and sell these units in real time. Okay, just because we say real time does not mean that you should ideally look at trading into these units. That's not the intent. But your mode of transaction would be through stock exchange, not via AMC. Okay. So one of the biggest advantage here of ETF would be, because the transaction happens through stock exchange, not with the asset management company or the company which has floated these schemes. These ETF schemes will hold lower cash component in the overall portfolio. Okay, that's one of the biggest advantage what you can actually have. Lower cash component means you will be much closer to the underlying benchmark. Okay, and at the same time, the overall expense ratio itself charged by these ETFs or the passive funds are much lower, as low as 0.05%. Or we call it as 5 basis points, and then it could go up to 1%. So that's the mix what we are looking at in passive funds in terms of expense ratio. So yes, so there is one active fund management where you allocate between sectors, stocks, large, mid, and small. There is a fund management element of human behavior involved there, whereas in passive funds it is only replicating the index. Okay, so how is it looking in India? If you look at the ETF scenario, okay, just recently National Stock Exchange released this data. In a span of 4 years, the AUM from 50,000 crores, it has almost gone up to 3,22,000 crores. Okay, that's how rapidly the ETFs have grown in India. And that too, if you see, interestingly, it is not just the gold ETF, because there was a time when we said ETF, the synonymous was only gold ETF. Now we have started seeing equity index ETFs as well as debt ETFs as well. Debt was minuscule as a number, but in no time, from 1,400 crores, it has gone up to 40,000 crores. So I think we are at a very interesting juncture with respect to passive investing. There is more and more number of people who are coming in and then investing. The question is, why should we really consider? Okay. See, like, let's say in a large cap fund space, I'm just taking an illustration. In a large cap fund space, if there are, say, 30 funds, okay, each mutual fund house having one large cap fund, it's how will you know which large cap fund to invest? And just because a particular large cap fund has done very well in the last couple of years, what's the guarantee that it will do well in the coming years as well? Okay, where is that they could go wrong? So the illustration what you see is an actual performance of large cap funds for 3 years. I've taken 2017, 18, 19, 3 years. What has been their allocation to automobile sector vis-a-vis the benchmark? If I look at Nifty, The allocation to automobile sector was 10.23%. In 2017. By the time it reached 2019, the allocation was 5.54%. So over 3 years, the allocation towards equity, the auto sector has come down in Nifty. At the same time, the performance also has given, like it's been there, like 2017, 18, 19. But 2017, it gave about 7.5% return, whereas 18 and 19, it gave about -15, -15% each. So in the, like, suppose you as a fund manager, you're sitting here today and you're taking a view or outlook on automobile sector. What would you do in the next 2 years if the sector is going to do bad? We don't know. I mean, this is historic. That's why it's easy for us to comment. Ideal scenario would have been the fund which has reduced the allocation to automobile as a sector should have beaten the fund, the underlying benchmark. But at the same time, the funds which gave higher allocation to, like let's say automobile probably would be lagging. I'm just giving you as an example here. If you look at Fund 1, okay, in the year 2017, their allocation to automobile sector was 15% in their portfolio. But subsequently, if you see 18 and 19, it is down to 3.23 and 1.62. That means they have drastically cut down. So from that angle, if you see, Fund 1 would have outperformed the underlying benchmark handsomely. Whereas at the same time, Fund 2, that is Fund 3 or Fund 2 for that matter, from 4%, they've increased the allocation to 17%, 12% increasing the allocation to 19%. Fund 2 and 3 would have lagged in terms of the performance. Similar in pharma sector or healthcare sector as well. 18 and 19 were relatively not so good years for 17, 18, 19, all 3 years for that matter, relatively bad years for pharma sector. But funds with a higher allocation to pharma in comparison to the index would have probably lagged in their performance. So what if you are part of those, like Fund 2 or 3 or 4, which didn't do well at all? I mean, consecutively 3 years you've been lagging. So instead, had you just been part of index, if you see, it has automatically adjusted the the weightage because of the change in market capitalization itself. Then your overall performance itself would have been adjusted accordingly. Okay, this is what we call it as risk adjusted return. So that's what so if you look at from 2011, I've taken about 6 large cap funds, very famous, least used large cap funds, out of which 4 years out of 10 years, the index outperformed the underlying benchmark all through. Whereas at the same time, in flexi cap space, 4 out of 10 years, let's say the index outperformed the average return of the fund. So that means large cap space, large cap active funds lagged behind. There is a good section of funds which kind of lagged behind in terms of the benchmark performance. So that's where I personally think, at least in the large cap space of these typical index, it makes sense for us to give some allocation towards index as an investing in the form of ETF or index funds, whichever suits you. But at the same time, understand Indian markets are maturing, so information availability and so on. All these things are definitely easier today for an investor to look at and then invest. So I think with markets maturing, the ideal shift is to go towards passive as well. Okay, have passive in your portfolio. Because there is no active management involved, the risk involved in passive funds are lower. So that's why we say risk adjusted returns are better. And of course, the expense ratio is less. So the element of the factor which brings down your returns is also less here. So from that case, I think the case is getting stronger for passive funds to be part of your core portfolio. I'm not saying all your portfolio should be passive, but some allocation towards your core portfolio should definitely be there. Okay. So on that note, I would like to call Pratik to take it from here. Thank you.
Hi, I hope, hey guys, I hope I'm live. looking forward to having a great discussion with all of you on passive versus active investing. I'm just going to put my presentation out here. I hope everyone can see it. But I just want to start off with saying that thank you, Groww, for inviting me for this. I think what all of you are doing in terms of investor education is quite phenomenal, and kudos to all of you. So just as an intro, I'm heading passive funds at Motilal Oswal Asset Management Company. We started a separate vertical that's dedicated towards passively managed funds, so ETFs and index funds. And today we have about 15 funds that we have in our bouquet of passive products, up from about 2 years ago. So we've been super active in this space, and we've also grown a lot. So I think we started off at about 200, 300 crores, and now we're close to 12,000 crores in assets. So, we've obviously, benefited from this entire sort of additional type of investing, which is passively oriented, which has come in India in a very big way. So today's topic is going to be active and passive strategies. So obviously, I represent passive funds, so this obviously is slightly biased, but I'll do my best in terms of making this as clear to all of you out there. And thanks, Karthik, for the really sort of informative presentation on active versus passive. I have a lot of similar content, but I'll try making it slightly different. So as Karthik said, if you look at the mutual fund space, there are typically two styles of investing. There is active investing and there is passive investing. So active investing is where you have a fund manager. You have a fund manager, and he or she decides which stock to buy, which stock to sell, and so you have active calls being taken by a fund manager, and he or she decides the entire allocation of how your money goes into stocks within mutual funds. Whereas passive investing is a type of investing where there is no fund manager. So you don't rely on an expertise of one person or maybe a team of people to choose which is the best stock, which is the like a not great stock to have in your portfolio. So passive investing requires like an AMC or an asset manager like us to replicate the index or the index. And I'm sure a lot of you would have heard of Sensex and Nifty. These are extremely popular indexes. Almost everybody knows what they are. They capture broader sort of market trends, and typically an index fund that is investing into a Sensex, will replicate the stocks of that index in the same proportion and the same number of stocks. So, for example, you bought a Nifty 50 index fund or an ETF. Your portfolio will have the same amount of stocks that is there in the Nifty 50 in the same proportion. So, for example, if Reliance is say 10% of Nifty 50, then even you would have a 10% allocation to Reliance in your index fund. So, the whole point about passive investing or passive funds, is to replicate the returns of the index. So, tomorrow the index goes up 5% or 10%, your portfolio or your fund will also go up by the same amount. Extremely important. So what I'm showing is just some of the basics, sort of the difference of what active and passive investing is. In active investing, you obviously have, as I said, you have a fund manager. You buy stock basis on your research, your strategy, your style. So it's very important for investors such as you to understand what the underlying strategy of the fund manager is. Simply buying the highest performing fund is also a very bad strategy. So it's very important for investors to know more about what the fund manager is trying to do with your money. Again, active investing, it aims to beat the market returns. Market returns is a benchmark. So all actively managed funds have a benchmark that they have to. That's the mandate. The mandate is to beat the benchmark, because if you don't end up beating the benchmark, you're better off in a passively managed fund. So essentially, that's extremely important. Then, which is why the opportunity to make lots of money is a lot higher in actively managed funds. Passively managed funds, the idea is not to beat the benchmark. So if you see a passive fund which beats the benchmark, it's not a good sign. It's probably not a well-managed fund, or the fund manager is taking too much risk or not doing his job properly. So the whole idea behind a passive fund is to replicate the benchmark. So your return should be as close as possible to the benchmark. So the whole idea about a passive fund is to participate in the growth of the overall economy. So it's not really taking a call about this sector versus that sector versus its stock. It's to just purely buy the top 100 or top 50 or top 500 securities. Or obviously you also have other strategies as well. So that's basically the difference between active and passive managed funds in India. So what are the pros and cons of these two styles of investing? In active investing, what are the pros? Pros is obviously, you have the opportunity to get better returns than what you would make in a passive or more returns than the benchmark. This is very important because, investors who feel that they can choose the right manager, then are able to beat the benchmark and make higher returns. It also offers a lot of flexibility. Why I say that is because there are hundreds and thousands of active funds, and all of them are very different. The fund manager very different. The style is very different. The philosophy is very different. So you get a lot more flexibility, when it comes to managing your money. So you get to have one person who's obviously taking care of it. You also have better risk control. What does that mean? So fund managers obviously are extremely experienced. So, they get to, control the risk in a portfolio. Say today markets are very expensive, and if fund managers feel that, no, it's too expensive, they would hold some of the money in cash. So, so I think you can also sort of choose to have a certain risk profile, when you are managing, investing in an actively managed fund. So what are the negatives of actively managed funds? One is, and this is the most important, is high fees. Most people don't realize this, but I would say the compounding effect of fees is quite large. I will obviously come to this sometime later, but fees are relatively higher because unlike a passive fund, in an active fund, you're actually having an expertise of fund managers, so you have to obviously pay them more. The second is style drift. What does that mean? What that means is that all fund managers have a certain type of style. They have a certain expertise. You might have a quality fund manager, you might have a momentum fund manager, you might have a fund manager who's only buying low PE stocks. So what happens in an active fund is a lot of times, in my experience or in the industry's experience, fund managers tend to change their style over time, which is a very negative sign. So I think that's a big problem. So when you invest in the fund, they have a different strategy, and in 2 years later, they have a different strategy. That's a big risk in an active managed fund. And third is benchmark hugging. What does that mean? That means that a lot of passive funds, in India today, are merely, benchmark huggers. That means that their performance is pretty much, very close to the benchmark. So it's not really giving you as much value add as what you would want in an active fund. So that is some of the sort of challenges with active funds in India. What about passive funds? What are the pros of passive funds? One is, the number one pro is simplicity. So today the problem in the industry is a lot of choice. You have so many mutual funds, you have PMS, ETFs, there's a lot of like complicatedness in the industry, which will only go up over time. So, index funds or ETFs make it very simple. Instead of you trying to choose between 100 large cap funds or 200 mid cap funds, you can just buy a mid cap index fund or a mid cap ETF and you're done with it. So number one, simplicity. Number two, transparency. You know exactly what's in your portfolio at all times, because generally you're just buying the index. So you know that the larger companies will have a much larger stake and all of that. So very important. Transparency is very high in terms of passively managed funds. And this is why a lot of investors tend to hold on to passive funds for 5, 10, 15, 20, even 50 years, because the strategy is very consistent over time. Third is low fees. Unlike an active managed fund, passive funds are extremely low cost. Today you have passive funds coming at 0.06, 0.1% Nifty. So I think it's super. So you can expect them to be a lot low fees. So you have more of your money is invested into the underlying stocks so that they can generate value. Some of the some of the cons of passive investing. One is no outperformance. In fact, even passive funds, almost all of them actually don't even meet the benchmark. When you account for fees, transaction fees, and expense ratio, all passive funds, ETFs, and index funds tend to underperform the benchmark by a small amount every year. So that is something which investors should account for. That you won't replicate the benchmark perfectly. There's always going to be small difference. Second is so the index obviously can act in weird ways. Sometimes the index might be structured in such a way that 30% or 40% of the index will be the top 20 stocks. As a passive fund manager, you can't do anything. So you have to replicate the index. So that's a risk that will happen. A lot of your money is in few stocks in the top, which is what you saw last year as well. And obviously, liquidity issues. What this means is that sometimes a passive fund might have small cap stocks or 500 stocks in the portfolio, and some of them might be very difficult to buy and sell. So in that case, you also have those issues. As an index provider, as a passive fund, you cannot take a call about which stocks you can buy or sell. So you have to add those stocks. And sometimes because of poor liquidity, by that, what I mean is if there is not a proper price mechanism, or if there's not enough sort of demand or in the market, then it'll be hard for like a buyer, like the AMC, to buy those stocks in the right way. So I think that's also a risk that comes with passive funds. So again, in terms of philosophically, I think this is a very simple way of why benefits of index investing is there. In Hindi, I would call it Sasta Sundar Tikau. So very easy to understand, as I said, very low cost, and also great, very effective, because we've seen over the last 15-20 years that returns of the broad-based indexes have actually been really good. So again, very important to understand. And just to let you know that yes, passive funds don't have to be that easy. Today you have a lot of new categories coming in passive funds as well. So passive does not mean a Nifty or a Sensex. There are hundreds and thousands of types of indexes available. For example, the US has close to, I think, 7,000 or 8,000 index funds and ETFs, and that's a huge number. So even index investing can be complex. So, but obviously, as I said, there are different categories. You have the traditional sort of Nifty, Sensex types index funds, but you also have sector funds, you have quant funds, you have factor funds, you have international funds, you have commodity funds like gold. So a lot of categories are in passive funds, but the main sort of commonality is that they're all passively managed. That means there is no fund management. So again, this slide shows the cost impact of what you would have if you I would say save money. So over 25 years, if you just invested 1 lakh rupees, then a fund with a lower cost will have 25% more focus. So I think cost does not really matter if you do it for 2-3 years, but if you invest for 50 years, and I'm guessing most of the people in this watching this are on the younger side. So it's important to keep costs low, because that can really make a big difference in your portfolio value over time. So within passive universe, there are two types of funds. One is index fund and the other one is ETFs, and both are passively managed funds. So they're just different sort of instruments. So index funds are similar to your mutual funds. So you can set up SIPs. You don't have to have a demat account. You don't have to go on the exchange. It's much simpler to invest. ETFs are passive funds that are listed on the exchange. So buying a fund on the exchange, say a Nifty fund or a Sensex or like a sector fund or a Nasdaq fund, buying on the exchange is basically just like a stock is an ETF. So those are two differences between index funds and ETFs. Both are extremely similar. There is no right or wrong about which one you choose. I think investors will choose which one is more comfortable and which is sort of they like more. Index funds tend to be slightly favored in today's time, because they tend to be a lot easier. You can set up SIPs. You don't have to worry of liquidity on the exchange, and also you don't have to worry of mispricing. What that means is in a lot of cases, ETFs, the price of an ETF should be 50, but actually it's quoting at 52 on the exchange. So that is a problem with ETFs in India today. But I think investors should keep that in mind when they're buying ETFs. But as I said, both are extremely good instruments. An ETF is listed on the exchange, so you can buy in the morning and sell in the afternoon. Whereas index fund, you only have to buy end of day, just like a mutual fund. You have real-time NAVs or prices of ETFs, whereas index funds is only end of day. Both are quite similar in costs. Just be careful that in ETFs you have extra costs like liquidity on the exchange. So you have some impact cost, or you might have to pay slightly higher to get that by the ETF, and also to pay brokerage and STT, where costs go up by a small amount. And obviously you need a demat account to buy ETFs. So this is again cost of index funds and ETFs. Since we're talking about passive and active, there's not really a lot to know about actively managed funds. I think a lot depends on the fund house and the strategy. But ETFs and index funds tend to be slightly more technical. But as I said, this is the cost that you would pay in an index fund. There is no brokerage, there is no liquidity cost. Whereas an ETF, the quoted TER is not completely correct. You have to account for broking. STD is not out here, and also liquidity costs. So you might have to pay, say, 0.5% more when you're buying and 0.5% less when you're selling it. So you have to account for this, when you're buying ETFs in the exchange. But this is what is like a lot of people would just simply say an ETF is lower cost while buying ETF, but most people don't account for these small things. So why has passive investing become big? Just like so this is just a case study of the US, where unlike I would say passive funds have grown dramatically over the last 10-15 years time. So share has gone from close to 10, maybe 20% to close to 50%. So it has become a pretty dominant way of investing. This does not mean that actively managed funds are doing badly. It's just that a lot of this active money has actually left the mutual fund industry. So a lot of these hedge funds and sort of these alternatives shops have become quite big in the US. So a lot of the money has gone from there to hedge funds. But nevertheless, it's become pretty dominant in the US and also in India. As you can see, passive funds have gained a lot of prominence over the last 5 years at least. You looked at close to 5,000 or 6,000 crores in assets in 5, 6, 7 years ago, and now it's 2 lakh crore. So I do believe that going forward, passive funds have a great scope ahead, and I think it's more people didn't really know what passive funds are, and now obviously you have a lot more mutual funds coming up with funds and a lot of education going, which I think is great for overall our industries. Why again have passive funds done well over the last 10-15 years is also because of underperformance, or what we've seen is and this is mostly in the US and also now slowly coming to India, is that a lot of these actively managed strategies are not doing as well in terms of performance. So if you're paying an extra fee, you need to have you need to expect the performance is good, but that sort of performance has come down a lot over the last 10-15 years. And also in the US, as you can see, about the US, about 80% to 85% of all funds in the active space have underperformed the index, like the S&P 500. So and India also, it's sort of happening in a very big way. So this is one big reason to why people are going to passively managed funds abroad and also in India and sort of other parts of the world. Also, as I said, alpha, which Karthik talked about, is outperformance over the benchmark. That has come down in India a lot. So back in the day, 5 years ago, there was no debate, but today I think that outperformance has come down. Markets have become a lot more, I would say, efficient. So it's very hard for fund managers today to find value, to find stocks that are low priced and all of that. So I think because of this efficiency, it's becoming very difficult for a lot of managers to be able to buy these funds. So that's extremely important. Why are passive funds? So I obviously believe that when you're looking at a strategy, you have to look at it. When you're looking at an active fund, it's extremely important that you look out for these things. Because and these are some of the reasons to why I would say most investors lose out when they're looking at their investments. One is obviously chasing returns, and this is a big problem. This is a global problem, but I will give you an example. So this is just a slightly complicated sort of style, but I'll try making it simple. These are the top 5 funds, in 2010. And as you can see, top 5 funds in terms of performance, in terms of, I think, 3-year performance or something. And as you can see, the top 5 funds keep rotating in their rankings. So if you buy a high performing fund today, which is how, to be honest, most investors tend to invest, it's not a good strategy because, most of them tend not to do well over the long term. I mean, they do well if you hold on to it, but there might be bouts of underperformance. So let me give you an example. Number 1 fund in 2010, became number 62. So a lot of investors get very, I think, anxious about the fund performance, but then it comes back to number 2 in 2014, and then it comes back again 2019. So people need to understand that when they're investing in actively managed funds, you're investing not in a strategy that is outperforming the benchmark at all times. You are investing in a strategy, and there are times in the market when the strategy will do well, and there are times in the market when the strategy will not do well. So, people, when they sell their poor performing fund and they're buying high performing funds, that's actually not a very good thing to do. Ideally, when you have a strategy, and if someone is sort of being consistent with that, might as well hold on to it for a very long time, because you can't really predict what's going to happen in the future. So I think, as I said, extremely important that most, I would say almost all active funds go through performance of outperformance and underperformance. So I think if you are an investor who wants simplicity, then obviously passive funds do the job, because you don't have to worry about performance. You will obviously get what the index returns, so you'll always get that above average returns at all times. That's extremely important. So, if you're a person that is buying high performing fund, and if you don't have the time to, really figure out what is the best fund to buy or what is the right strategy, then maybe a passive fund can make sense. Also fads, I think the reason why index funds are good is because they're very simple and they tend not to chase fads. So last year you had some rally in pharma, this year you have some specialty chemicals rally. So, passive funds are extremely sort of disciplined. They tend to do the same thing, just buy the index. So they don't invest in fads. And this is also one of the reasons to why a lot of retail investors tend to lose money, because they end up, investing in these fads. Third is risk profile drift. As I said, a lot of funds tend to, change their risk profile. So a lot of investors and a lot of fund managers as well, tend to move around the strategy, which obviously is not great. And last is over allocation. This is when it comes to asset allocation. So I'm a big believer of asset allocation. And if you look at asset allocation, then I would say it's important to allocate your money in different asset classes. So you can have domestic, you can have international, you can have debt, you can have gold. And if one asset class does well, it's important to prune that exposure and invest in your underperforming asset classes. So it's very important for you to have an asset allocation. And typically what happens is most investors, say, for example, last 1 year, this fund has done well, people tend to put more money in that fund and sort of take out their losers. That's actually not a good strategy. Most good investors do the opposite, which is trim exposures in high performing funds and buy their low performing funds, because in the long term, it sort of normalizes. So that's pretty much my presentation today. This is my last slide. This is the behavior gap. Basically, this is essentially, this is reality, by the way. So if you look at fund performance, if you look at fact sheets, if you look at I would say presentations of fund houses, you will see that what you make versus what you see in these fact sheets are very different. So and this is based on real study, that there's a 4.5% difference between what you buy and versus what you get. So this is the investment return. So return of what you're buying versus what you get in 2, 3, 4 years time. So I think it's very important that, these 4 things are not done, because this is the cause of behavioral is behavior gap. So it's very important that, investors do not invest in all market conditions. So for example, in today's market, everybody's investing. That's not a very good thing to do. It's important to, invest in good as well as bad markets. In fact, good investors tend to invest more in bad markets and sort of less in good markets. But essentially, you should ideally invest in all markets, and you should also not chase returns and invest in fads and do poor asset allocation, because that results to this 4.5%, which is quite high, to be honest. And this is based on real studies. So most investors tend to make this less than 4.5 returns than what you would see in your investments. So that's pretty much my presentation today. Just a list of funds that we have. Happy to answer questions if anyone would have. Thank you so much.
Thanks, Pratik, for that detailed insight into passive funds. So there are definitely some couple of questions we would love to get your perspective. So one is, whenever we think of index, right, with respect to be it active funds or passive funds, there's one particular term what we use is tracking error. So what is tracking error, and to what extent tracking error would be there in passive funds?
Yeah, it's a great question. So this is I don't know how I skipped this. But how do you choose between like the five, like I don't know, 30 or 40 Nifty 50 funds? There's so many out there. Almost every AMC has it. So it comes down to, I would say, two things. I would say one is called expense ratio, which is what you pay for the fund. Essentially, you should stick to a fund house that has a not the lowest, but one of the lowest expense ratios. The lowest fund is not the best choice, but make sure it's on the lower side. That's very important. And second is something called tracking error. I talked about the fact that in index funds and ETFs, there's a difference between what the index makes versus what the fund makes. And essentially, you want this difference to be as small as possible. And tracking error is basically a term that shows which is the most efficient fund out there. So the lower the tracking error, the better it is for the investor. A lot of investors also confuse tracking error with something called tracking difference, which is the difference between the fund and the index. And just to be completely sort of, I think honest, that's not the best thing to track, because, if tracking difference, so say last year, one fund did 50 and the tracking difference was 49 versus another more efficient fund did 50, and whereas the index was, much higher. That does not show that the fund with the lower tracking difference was more efficient. In fact, what normally happens is that, a tracking difference can sometimes be negative as well. So I do believe that a lot of people who compare differences between the funds may not be there, because you might have a situation where you have an AMC that is taking excessive risk or is investing disproportionately to the index for them to outperform or lower the tracking difference versus an AMC that's actually trying to do things properly. So I think tracking errors is the right way for investors to look at. The calculation is slightly complicated. It's the standard deviation of the daily difference between the index versus the fund. Not very important. What's important is that choose a fund with a lower tracking error and like a lower expense ratio.
So can we say how closely it is related to underlying benchmark? Can that?
Yes, that's right.
So Pratik, next question is, every market peak what we are touching right now, okay, there's always that stress for an investor. What's next? Okay, is this a bubble? Is it going to burst, and so on, right? So being in passive fund space, don't you be tempted to say that, okay, whatever money coming in, should I be deploying in now, or should I wait for the right time? Does passive funds do that?
No. So passive funds are not mandated to take any call on the market conditions or stocks.
If money comes in,
yes, the same day it gets deployed in the markets, last half an hour of trading, and we basically replicate the index as it is. So there is no call done by any passive fund in India. I mean, obviously, if you have passive funds, then they're probably not doing their job properly. But essentially, a good, well-managed fund would not take a call on the market or Sensex levels or Nifty levels. They just deploy every money, because the idea, as I said, is to track the index as close as possible, and for that you have to be invested at all times.
So you're market level agnostic. So you'll not look at what market levels are and then just deploy it, right?
Absolutely. Yeah, absolutely.
So definitely passive is a good story. I think ETF and index funds should definitely be part of the portfolio of an investor. What percentage allocation you think one should have? A basic thumb rule, if you have something on that.
Yeah, I mean, I wish it was as easy as that. I think most investors should invest as per their risk profile. That's extremely important. So, if you're an investor, and there's a very big misconception that age has to do with risk profile. That's not true. It's depending on your goals. So if you're investing to buy a house, then obviously you should not be very risky, say in 10 years. But if you're investing for retirement, which is 50 years from now, then obviously you can afford to take more risk. So number one, I think, invest as per your risk profile and your goals. Because if you're 100% equity and then markets do correct by 50-60%, you should not be deterred, and you should continuously invest. Second is, I think it can range. I think investors can, should deploy ideally. So if you're a very sophisticated investor and you think you are able to find the right sort of funds or stocks, then obviously you can look at a smaller allocation to passively managed funds. But I do recommend at least 30-40% of your portfolio should be in passively managed funds, something which is a core allocation which you would not touch for 10, 15, 20, 25 years. And then obviously you can combine that with if you want other funds or maybe thematics. I don't recommend sector thematics, but you can also do that. So I think it really depends on the investor to investor. But essentially, a passive fund should be a fund where you want to deploy your money for a very long time, and you don't want to touch it. Whereas sort of other strategies are what you would do it for, maybe 3 to 5 year sort of horizon.
Sure. Yep. No, I think that really makes sense. Look at the goal. Suppose the goal is really long term, giving, I think 30-40% allocation to passive should be a good strategy to follow. But again, it varies from individual to individual. Please do not take this as a recommendation. See, there is with active management, there is always that expectation that when markets are going down, how do you judge a fund whether it is performed or not? That the fund should have fallen lesser than the market. Do you have any such research outcome? What you have that, especially in bad markets or very high volatile markets, passive funds have done well compared to the group of active funds? Any such study which?
Yeah, I think it's a good point. Essentially, it may not might not be actionable advice to invest differently in bear versus bull markets, but yes, there are studies which show that that as I said, actively managed funds can do better risk control because they can choose when to deploy money, when to keep money as cash, and historically it has seen that there is a slightly higher outperformance of actively managed funds during down markets. So that is somewhat true, but ultimately it really depends on the strategy that you're investing. There might be strategies where where it might actually do worse in downtimes. If you're investing in extremely risky stocks, for example, in 17, 18, just to talk about history, a lot of funds end up over investing in small and mid cap stocks because they were doing so well before that, and which is why a lot of them tend to sort of underperform the passive fund, index funds because of that. So I think it really, as I said, it really depends on the type of fund that you're investing in. But yes, there are better risk control measures because you have the choice about which stock to buy. So you could have a low volatility strategy where you only want to buy stable companies which don't really move much. And that could be a much better sort of I think fund versus a pure play index fund where I think if the index is down 40%, your fund will also be down 40%.
Yeah, I think whole of 2019, I think mutual fund industry was answering this one question: markets are doing well, but my funds are not doing well. I think that was a very classic case which we saw where the allocations going wrong with. Where the markets are doing well, but your funds per se have not done well. I think this is where I makes sense. Next question, Pratik. With respect to investing into the index stocks, there are also people who follow this strategy that every month I'll do stock SIP into these selected stocks. They have their own filters and then say, okay. So which is a better strategy, investing into selected stocks on a monthly basis or an SIP into an index fund, or someone could follow both? What's your take?
Yeah. No, so I don't recommend. So if you're doing an SIP stocks, then obviously I wouldn't compare, buying an index fund versus buying a bunch of stocks and doing an SIP in them, because number one, an index fund there's no tax in an index fund. By tax, I mean so if I as an AMC rebalance my portfolio this quarter, the AMC pays zero tax, whereas an investor will actually pay capital gains tax. So I think mutual funds are very tax efficient. So which is why I think it's extremely important that I think if you want to have an index style investing, invest in the top 10, top 30, top 40 stocks, then index fund is the best way to invest. The second is that it requires heavy monitoring. What do I mean by that? It means that, say 2005, if you're invested in an index fund, say 2005, your portfolio would be industrials, I would say oil and gas, I would say a lot of capital goods sort of sectors, your index. And whereas if you see today, your portfolio is more financial services, telecom. So I think the beauty about the index is that you'll always have the top 50 or top 100 stocks at all time, regardless of what happens with the economy. Whereas if you're holding stocks, then you have to take a call about when to enter, when to exit. should you rebalance, should you not? So the index does itself completely. So I think if you're looking from investing for a very long time frame, I think you're looking at it from like you have the index self rebalances every year. So you don't have to worry about not owning a good company, say 10 years from now, the index will do that job for you. So I think it requires a lot more monitoring as opposed to an index fund. You don't have to worry about it, and costs are pretty much very less.
Thanks. So all thanks to 2020, the concept of investing outside India became really prominent, right? I think we talk about reducing the overall India as a country risk, the systematic risk, by investing in foreign markets. Right? I think so. If someone were to look at investing in foreign markets for the concept of diversification, which is the index one could look at? Nasdaq 100 or S&P 500, or just be part of FANG stocks? What do you think is the right way to look at?
Yeah, I think it's a great trend. When I came back to India, so I was in the US. I used to be a wealth manager. So, and all my clients, I had about 700, 800 of them, had between 20 and 40% allocation, outside of the home country, which is outside the US. And when I came back to India, I was like, no one's investing outside. So I was like, and we obviously have this really good Nasdaq fund, which is a good fund, which is a good ETF. So we sort of, went ahead and pitched this to clients, and obviously now it's a very different ball game. I think people have adopted international diversification as a very big way. A lot of it has to do with past returns, but I keep telling investors that have low expectations. The future will not be as good as what you've seen in the past. But essentially, as you said, when it comes to international diversification or international buying, I think keep it very simple. I obviously so we at Motilal Oswal only. We obviously believe in stock picking in India, but when it comes to abroad, we believe that an index fund or an ETF is a much better vehicle. Number one, it's a lot more efficient. Number two, it'll do well than 80-90% of all of the active funds, because I think efficiency is a lot higher outside. So I do believe that an S&P or a Nasdaq, both are great indexes. If you're looking for something a little bit more growth or tech oriented, then you have the Nasdaq. If you're looking for a little bit more diversified, then S&P 500 is the most popular index in the world. So I recommend obviously both. I also recommend investors to go outside the US. There's too much focus in the US in the last 10 years. I think it's important to have a global portfolio as well. So investors should look at
examples of such global portfolios, if you can throw some light on.
So currently, to be honest, in India, there's very less options on the mutual fund level. So we will be launching an emerging markets index, also developed markets, so Europe and sort of Japan, and also. So I think we're obviously trying to do something there, but obviously, regardless, investors should look at a total global portfolio. Which is a combination of US and Asia. Like for example, China has become very prominent, so investors should definitely diversify there. And you have other emerging markets like Taiwan, South Korea, which is also a great market. So I think overall, you should look at it from a global perspective and not only US.
You've already answered this question again for the benefit of the viewers. Whether someone is a seasoned investor or a new investor, what should they start with? Should they start with like an active fund or a passive fund? Suppose if I'm a do-it-yourself kind of a investor, does not have any help from anyone, coming into like let's say Groww platform, buying in mutual funds. So what should I start with? Should I start with active funds or passive funds? If active funds, if passive, what kind of funds?
Yeah, sure. So I would say, if you're new to investing, then obviously it makes sense to go for a passively managed fund. I think you have to be able to build up your knowledge base, and I think as a newbie, it makes perfect sense to invest in something like a Nifty 500 or a Nifty 50. Where you know exactly what stocks you're buying at what proportion. So something as simple as that, like a simple Nifty 500 fund where you're buying all of India in one fund, or like an S&P 500 fund, you're getting international diversification as well, and maybe a gold. So I think keep it very simple. I think that's more than enough, to be honest. I don't recommend investors hold 10, 15 funds in their portfolio. 4 or 5. I mean, I have one fund, but I think 4 or 5 is sufficient for your investing needs.
Okay. So you mentioned the fact that as passive funds, as a fund manager in there, there's no liberty for you to time the market, be it at the markets going up or coming down, and and you also don't have the flexibility to change the allocation towards sectors, because if you think a particular sector is not doing so well, or a particular liquid stocks, isn't that itself, all these things itself work as a big disadvantage for a passive fund?
Well, not really, right? Because I mean, you don't want to optimize returns, right? Like I mean, we want to get the index returns. So whatever the index makes is what you as a manager want, you as a AMC house wants to. So there is no fund manager, as I said. So it's not a disadvantage. In fact, it's an advantage because number one, you can't time the markets. There's been like thousands of studies which says that you cannot time the markets, and I think most people, I would say, who try to time the markets actually get it horribly wrong. And I have seen it in my life, in the US and also in India, where most people who tend to time the markets end up doing a lot poorly. In fact, the best ways is to ride the wave and doing an SIP across good and bad markets. So I think investors are doing themselves a huge amount of injustice, or not great things by timing the market. Almost no one from the industry, from the AMC industry, will tell you time the markets. So I would say just stick to your investments. And I think if no one can do it, then what makes us as an AMC or anyone else be able to be good at that? So I think, as I said, that's actually a boon, because no one can really predict what's going to happen.
One last question, Pratik. See, there's always this mechanism with respect to ETFs, right? So we say 1/10 or 1% of the overall Nifty value would be the per unit price. Some ETF, like NAV, is slightly higher than the market. When we say that the particular fund should ideally be, like let's say mirroring the index, or the return should be slightly lesser than index because of expense ratio and also because of cash holding. What could be some of the reasons why the NAV is slightly higher than the market itself?
Yeah, no, it's a good question. So, if you look at, so this is not a problem with index funds. So with ETFs, which is extremely popular, and it's a great way of investing also. What happens is, you have to buy units or on the exchange, BSE, NSE, whatever it is. And what happens sometimes, and most of the time, like actually, is that there is no seller. So when there is no seller, and when you are the buyer, what price should you buy it at? And what happens is, if there is no seller, you have something called a market maker or an authorized participant, who's basically the market maker. So if you are buying and there's no seller, they actually work with the AMC or the mutual fund to make sure that you have your units. And for that service of providing units on the exchange, whenever there's buyers, or if you are a seller, and if there's no buyer, then they would buy from you. They would charge you a slight premium of, say, maybe 0.5% or maybe slightly higher. So I think this is something which investors should know, that buying on the exchange, there's a very high probability that you will be paying above what you're supposed to pay, or the underlying INAV. So it's called the INAV, which is called the indicative NAV. Which you can find out in all AMC websites that have ETFs. And you have to make sure as an investor that your purchase price is close to the INAV, because sometimes what happens is a lot of AMCs don't have good market makers. And what happens when you don't have a good market maker is that you end up paying 1%, 2%, sometimes all the way to 5% higher in what you're supposed to pay. So I think that causes a lot of problems in your portfolio. So I think this may not be a long-term problem, but currently in India, ETFs are not very liquid. There's not a lot of buying and selling happening, unlike stocks. So investors need to be slightly careful when they're buying these things on the exchange.
Sure. So thanks a lot. Thanks, Pratik, for being part of this. We really got to learn a lot about passive investing, ETFs per se. So thanks everyone for joining in for today. Have a great weekend ahead. Thank you.
Yeah. Thanks everyone. Thank you, Groww, for having me, and I look forward to more of these events. Thank you.